So welcome back to the part 4 of the buy and hold series. This will be the last part. So I'll summarize a lot of things in this particular part. It's not going to be a usual chart specific episode, but it's more towards rules driven approach and what you should be avoiding in the market. Towards the end of the video, I'll also give out a layout of what you should be doing in the months ahead, especially now that the markets have run up too much. So the first key rule of what I've taught, or what many legends have also taught in the market, is that you need to get started as the market corrects. Now, when Nifty was moving lower in the month of October, November, there was a reason why I was again and again telling, please start preparing. Start preparing because this is a phase where you kind of prepare for the next leg in the market. And unless and until you prepare, unless and until you do that particular grind work, homework, or whatever you may want to call it, it gets a bit difficult later on to catch up. Now, if you look at what has happened in the market recently, the markets have just taken off from the month of October, November, mainly from November second week. And had you not prepared in this particular phase, then a lot of people would be coming in here as the market is rising through gaps. A lot of desperation comes in and those kind of things. So this is precisely why you should always get started when the market corrects. The problem is the news flow is so horrible. The problem is social media, news channels, everybody is highlighting on aspects that are only relevant in the short term. And this is where the major problem lies. It is not in skills. It is not in the fact that people don't want to make money. But the problem is there is a battle of assets going on in our market in particular. I'll share two slides with you, all right? One is a technical one and another one I borrowed it from a website that I was reading. I'll come to that in a bit. The battle of assets is actually between FNO and equities. And clearly, if you look at the data, if you look at the recent trends, if you look at the talking points, all surround around F and O. And this is the biggest reason why people cannot become buy and hold investors or buy and hold traders, because everything these days is centering around the word futures and options. You got to understand what I'm going to speak now. While the majority of participants were looking to sell the next option or straddle or strangle or whatever, market has quietly moved from 19,000 to 21,000. Repeat this line many times in your head. If it doesn't make sense to you, then you're a short-term player, and obviously this channel is not for you. But if this makes sense to you, that as traders were focusing on the short-term noise here, this has gotten over, and quietly the market has moved from something like sub 19,000 to 21,400 now. Just imagine the kind of opportunity, kind of cost that has gone on in this phase. And I know that there are a lot of people trying to ride the next option here, trying to pocket the next few cents, whereas the market was clearly offering a lot of dollars. And it is still offering a lot of dollars provided your time frame is right. The next thing is power of compounding. Now, this is a word that is repeated so many times, yet to realize power of compounding, you need to hold on to stocks when things don't look a lot good on the chart. That is when stocks are falling, news flow is not good. It's very difficult to hold on to stocks. It's very difficult to have conviction, again, because there is a lot of talk around short-term data points. Do not forget, again, what you're going to hear. In futures and options, your taxes and your losses will compound over time. In equities, your money and experience will compound. Again, very few will understand this point. Very few will understand, because if you look at the craziness that is going on in India, I'll just take you through two charts right now. First, I'll pull out this particular chart. So this I have taken from Money Control website. I was reading an article about, they were covering about futures and options volume. This is derivatives to cash volume ratio. This is as of 31st July. And look at what is happening in India. The derivatives to cash volume ratio is 420 or whatever this number is in India, whereas next is Germany at 36, in US it is 9. In Japan it is 2, in Poland it is 1. This is nothing but short-term gambling. And yes, apart from the professional people, apart from some of you who are doing it with your portfolio or to hedge or any relevant strategy that you're using, or maybe you're using fraction of money for FNO, apart from this, majority of people are gambling in India when it comes to FNO. And this entire ecosystem is rotten. Ecosystem is rotten because nowadays you see majority of mainstream media, social media, so many people are dedicatedly having sections to help retail investors, traders know which next option they can buy or which next option they can sell. It is nothing but, it's terrible to see that, because every penny that you are putting in FNO and losing is the penny that you can put in a good mid cap, micro cap, or small cap company or a large cap company that is going to pay you really, really, really well over a period of time. Look at the India cash and derivative market volumes, that is dollar billion per day. It was 5 and 15 in FY10. While the cash volumes have just about doubled, look at the derivative volume. This within itself is speaking a lot. Again, majority of people are active in the FNO segment, and then comes day like Wednesday, Thursday, when the market gapped up 200, 300 points. I was looking at call options or put options, mainly call options were up 300, 400%. I mean, people are willing to lose 400% on their call option, but they are not willing to invest that money in equities. That is the heights of stupidity that is going on in the market. Don't fall for it, please. The next chart I'll show you, now that the market is at 21,323, as of recording it's at 21,330, the next theory you're going to hear over the next few weeks is the gap theory. And this will be responsible for a lot of people not participating for the next cycle. What is the gap theory? Now you will start hearing that all these gaps that you see on the chart, these gaps will be closed out, which means Nifty is going to fall as low as 19,500 or 19,200 or 19,100, and that is when people should come in. This is the next theory due to which a lot of people are going to not invest. A lot of people are going to write and sell calls and those kind of things. It is coming, and it is a part of a larger theme that I'm discussing here. People don't recognize the power of compounding because of the short-term goals, short-term kind of things. And there is a genuine battle of assets that is currently going on. In this particular series, since this is the fourth part, I'm going to summarize a lot of things. Between the month of October to November, or for those of you who are in the early 2023 cycle with me, that is January to March, there were just 3 steps I was following, and every week I used to say about it, along with my rant against FNO. That is, identify sectors. Which sectors can move up? Which are the sectors that you understand? Which sectors of the economy haven't performed? Which were my sector bets? It was banks, IT, metal, and FMCG. And what has happened in the market now? Pull up the charts of all these sectors and you will see what has happened. Identify stocks. Which leading stocks are being neglected? Which stocks are drivers of growth for this country? Which stocks are market leaders? Which stocks are breaking out? Again, the things were pretty clear. In banks now, because it has happened, I can speak about it. There were only 2 stocks that were breaking out, large cap stocks. It was IndusInd Bank and Axis Bank. In public sector banks, it was Canara Bank, Union Bank, it was Punjab National Bank, it was a couple of more names. Now SBI is also setting up. But these things were very clear right from the beginning. Karur Vysya continues to go from strength to strength. Within metals, which stocks were breaking out? It was Tata Steel, JSW Steel, it was JSPL, it was JSL. It was not rocket science. In IT, which were the 3-4 stocks? It was Coforge, LTTS, Persistent. So these things were clearly visible. All right. And the reason why people don't want to see that is because they get into this thinking of, what if market has to start to fall tomorrow? What if these things were to happen? So this is the single biggest reason, along with the battle of asset classes, that people cannot convert themselves from a good trader to something like a buy and hold long-term kind of a trader. By long-term, I mean till the point structures are valid. And the third step that I was doing is how to enter and exit. Which are the patterns that I want to go behind? How do I exit positions? So many times I've explained trending pivots. Look at trending pivots on time frames that you understand. Don't go below hourly or 75-minute time frame. It's a waste of time. If you were to take my opinion, stick to something like daily, weekly. It is fantastic. You don't need anything else. Then comes the phase of knowing your risk profile. Now, risk profile is important to understand what kind of a position sizing method you can use, whether you're a conservative, moderate, or aggressive investor. If you're conservative, you can go via SIP, STP route, buy and accumulate at every dip in the market. This process is boring, but let me tell you, you will be rewarded over time. It's boring because people want fast money. What are the kind of content that does really, really well on YouTube or Twitter? It is the content that will take you towards short term. Whereas almost every channel or every Twitter handle that focuses on long term will grow terribly slowly. Why? Because majority of participants come in with the gambling mentality. I want to go into FNO and write those calls options, get those few lakhs, buy that new car. That is the mentality. If you were a moderate kind of a investor trader, your combination would have been STP and one-time scale-in. STP is nothing but systematic trading plan where you identify a stock and then slowly, gradually accumulate that particular stock. Maybe every day systematic putting money, or every Friday. That is completely up to an investor's choice. And aggressive is someone who can use a one-time scale-in, that is going in all in particular stock, or pyramiding, buying 34% plus, then 33%, and then 33%. So this was the second kind of a step that is required to be a buy and hold kind of investor. Now, today I'm not going to cover all these names. In the previous videos, I've shown you these 30 names. The last 10 names, again, it is the same thing, same cup and handle, same contraction, same volume, same relative strength. But the last 10 names, again, starting from Precall, Reflex, Archeforge, Royal Lockheed, RVNL, Saxoft, S-Chand, Chevrolet Metal, Sunflag, TA Wabag, and Wonderla. What are the returns? 53, 95, 146, 12, 100, 197, 18, 4, 45, 73, 92. So this is what has happened for my March and April list. And when it comes to the recent list in the market, I'll start covering it after 3-4 weeks, but the process is entirely the same. I'll first cover it sector-wise along with the market updates that usually come out, but I hope you get the point. Now, I'll take you through what has happened in the market currently and why, again, a lot of people are going to commit huge mistakes. Look at Nifty, extension from November. Look at banks, look at IT, look at metals, look at infra, look at auto, look at FMCG, look at PSU banks. Again, look at Nifty Pharma, Nifty Healthcare, Nifty Consumption, Nifty Energy, Oil and Gas, Financial Service, Realty. It's telling you that this specific move that has come in the market has been highly broad-based. Such broad-based moves don't end early. Yes, you cannot expect now Nifty to go from 21,000 to 25,000 in the next 2 months. Alright? You just cannot expect that. But the market needs to digest those gains, which means in the next 3 odd months, you will see a phase where markets will get into a consolidation kind of a zone, and then again, stage a breakout. In between, stock specific action will continue. So the focus will shift out of index towards stock specific action. Now, there are 2 cycles I've shown here. One is the cycle of desperation and one is the cycle of work ethics. Let me explain this. First, let me take you through this chart. Just memorize this chart from September to November, okay? And this will be understood better by those who come week on week and watch whatever I have to speak about equities. So just have this phase in mind, October to November. When the phase of October to November is going on, majority of market participants, number one, are in a boring phase. Alright, they are completely in a boring phase, not doing anything. In the mid of November, this is what they go through, which is desperation. This is disbelief. This is desperation. Disbelief means they just cannot believe what is going on the screen. And somewhere here. Market was just at 18,800, now it's at 19,900. What is happening? But because they have done nothing in this boring phase, they just don't know how to participate in the phase where the markets were rallying in November. And then now that you see in December is a phase of desperation, where people are coming in, bringing money left and right. Every day you are seeing headlines of Nifty at all-time high, Bank Nifty at all-time high. Investors coming in, foreign investors coming, putting in money. Then you have, most of the market commentators telling you that this is going to continue. Now FIIs are going to come in, India is a great story, and those kind of things. Now, do you remember the October-November cycle that I just showed you? For the next cycles, you have to change this cycle of desperation to the cycle of work ethics. Now, what does this mean? In October and November, religiously, you should be doing homework. If there is one message that I gave through my boring videos between October and November, was don't stop doing your homework. Create your watch list. Because when the market starts turning, it is your watch list that is going to tell you where to get in and how to get in quickly. The second phase is the phase of entering, asset allocation, position sizing, setting your stops. And the third phase is a phase where you just relax and do nothing at all, because this is a phase where you've already done your work, and this is a phase where you now have to sit back and absorb whatever is going on in the market. And I'll just show you the same remark this week that I made. I'll just, what am I writing here? Just yawn and trail, nothing more to do. Structure is same for Nifty Bank. Do not second judge where the price can go. Targets is for fools. Following price is what professional students master. So this is nothing but this particular slide I'm explaining here. But this phase will only come when you go through rigorous process of identifying what can move next. And once you have that list, once you have that sector and stock list in front of you, then these phases get relatively easy. So if you haven't been, let's say there is someone here who has been through this cycle now, from going from this cycle to the cycle of work ethic, this phase is the most important phase, where the market is correcting, when things are not looking great on the screen, when there is not by that kind of an environment on various media sources. This is when you gotta put in a lot of effort, and only then you realize the next two phases that come in market. Now, how do you proceed further from here? What if you have missed out? The first thing is you got to learn. You got to learn, because there are a lot of people who would have missed out, and that is fine. Every cycle is a learning cycle. Market is not going anywhere. There are three things you'll have to follow. The first is thinking about risk reward. Do understand that things have run up too much now in the market, and you will have to wait for a cool off period. All right. Now that cool off period, according to me, will happen between Jan first week and March last week. Again, this is just a kind of a assumption that I have currently based on how cycles progress. And obviously, as you come in every week for market update, because regular updates I'll start from next week, I'll update about how things are going. The next part will be strategy. I would tell you between now and March, stop buying breakouts. In fact, focus on those stocks that have been in clear trending structures and are pulling back now, because these are the stocks which are more likely to set up and move up. Because the stocks that have taken Nifty from 18,800 to 21,000 are not going to take it up, take Nifty up from 21,000 to something like 23,000. Probably they will consolidate, whereas new leaders will set up. Not leaders, but new kind of consolidation phase will happen in stocks that broke out early. The third is a broad outlook that I have, that the dips in the market will be very, very shallow. I don't think that market is going to dip a lot. I think even Nifty Bank will consolidate in a tight range from January, and by tight range I mean between 3 and 4%, and will then further move up. So every dip in the market will be bought. This means that there is still a lot of desperate money that is waiting to come in. See, I'll tell you one thing, that when I showed this particular cycle of work ethic, I like to link it with the chart here. I'll open up the larger chart of Nifty. When the market was here, there were 2-3 things that I was thinking. Number one, that banks, IT, metal, FMCG will be rank outperformers, and number two, BJP will lose all state elections. Now just imagine, had I been not doing my homework here when the market started moving up here, and I wouldn't have been in a place to pick up stocks, I would have technically missed out everything, because my opinion was that BJP will not do well, and short term will be relatively tricky. This is where work ethics matter. Let some time pass. I'll definitely show you what I was thinking in this cycle, because I document my notes in community section, and I'll show you my remarks every day, how to build positions, which sectors, and those kind of things. Just give me some time, I'll show it, because those trades are still valid, so it won't be ethical. Let that time just pass, maybe couple of more weeks, then I'll open up and show you that. But it is all due to work ethics. Coming to this point, there is no sector, as I showed you in the charts, that particular sector is currently buyable unless and until your time frame is really long term. So you will have to wait for a period of cool off. The period of cool off will be sideways in nature. The way to identify stocks now is to look at those stocks that are having pullbacks, and there are plenty of stocks having a pullback. I'll just show you one structure. That is the structure where, because I'm discussing this, so obviously I won't go ahead and take any position. So I'll just give you an example what kind of structures you should be looking at. So if you open up the chart of something like Gabriel, again, I don't have any holding in this. Can you see this chart? While Nifty has been consistently moving up, Gabriel is doing this. It is just consolidating. Now I'll mark this as a broad kind of a range here. What it can do, again, it is not forming some great candle, so maybe we'll have one more leg down. But somewhere down the line, such structures, what they do is they form one more kind of a base here, and then they stage a breakout. Look for such names. Do not look for names that have done this with Nifty. Instead, look at those names that actually moved before Nifty, but now in the last leg are doing something like this. So you're essentially looking at leaders, but leaders that are again looking to set up while Nifty starts consolidating. So that would be a much better approach, as opposed to picking up scanners and trying to go behind stocks that are breaking out today, because those stocks have already run up. And when you go behind such stocks, believe me, what is going to happen is you're simply going to face retracement, and that feeling of again getting frustrated will keep coming back, because this is the second time this would be happening to you after you've missed out on the initial phase that the market has gone through. All right. So for those of you who are new, you'll have to go through the part 1, 2, 3, 4 to understand what was being discussed here. So the buy and hold series ends here. From next week, regular updates will begin. Hopefully this was useful. Leave your comments below. I'll definitely answer most of your questions. So have a great weekend ahead. Take care and be safe.